Hi, I'm Becky Estep, and I'm with Credit Coach. I would like to go over some credit education with you today so that you can be more informed about what it takes to buy a house these days, about credit, and about how it all works and all the little secrets that nobody wants you to know about. Also, I would like to go over some simple definitions of things that show up on a credit report so you understand what you're looking at every single time you look at your credit. So, let's get started. As far as lending is concerned, there's three different types of loans out there. There's FHA, VA, and conventional loans. FHA is the most popular loan out there these days, so that's the one that we like to go over with our clients. As far as FHA is concerned, they require 3.5% down, a 620 to 640 middle credit score, 41% debt to income ratio, 2 years employment in the same field, and 3 open lines of credit for 12 months or more. So, what does that mean to you? What that kind of means is that whenever you go to try to purchase a house, say you make $2,000 a month, you can take about half of that and use it towards a house payment if you chose to, which would be about $1,000 a month. So at a 10% interest rate, that means that you could get and afford about a $100,000 house. So if it's 3.5% that you're required to have as a down payment, then that means you need to come up with $3,500 down while we're doing credit repair for you, so that the end result is that you get what you want. You be able to get that dream home that you've always wanted to have. Okay, so let's start going over the different scoring models that gets a credit score. There's a FICO scoring model, there's credit advantage scoring model, there's so much stuff out there, who knows what's what. But the FICO scoring model, the way that kind of works is mortgage brokers pull that scoring model, banks pull that scoring model, car lots pull that scoring model. But whenever you go online and you see the credit monitoring stuff, like Credit Karma, freecreditreport.com, Identity IQ, all of those companies, they have different scoring models. And so say you go pull up Credit Karma. Sometimes the score is not going to be the same as if you went to a bank or if you went to a car lot. It's just a general idea of what your credit score is. And so that's can be kind of confusing sometimes. People come in, they think they know that their score is this, they get in and it's 50 points lower because they went to Credit Karma first and they go to car lot. Car lots, sometimes they have credit scores that weigh more heavily on how you've paid for a car, where a mortgage company sometimes weighs more heavily on what you've done with mortgages. And so that's where those different scores come in. Let's talk about the FICO scoring model and how that works. As far as FICO is concerned, 35% of your credit score comes from payment history. Do you make your payments on time? 15% comes from credit history. How long have you had something open? The longer the better. Closing out credit actually lowers your credit score, potentially, because you don't have that positive trade line reporting over and over and over again, open and active, and still helping increase your credit score. That's why it's bad to close out credit cards that you've had open for years and years. 10% of your credit score comes from new credit. That's 10% to the good or 10% to the bad, just depending. When you put big new debts on your credit that hasn't been paid down at all, it actually lowers your credit score at first until you've paid down some of the payments, so your debt to income ratio isn't so high. 10% of your credit score comes from types of credit. There's 3 different types of credit. There's revolving credit, like credit cards, which counts 30% of your credit score. There's installment loans, something you have a set amount of payments on until you're done, like a car payment or student loan, something, or a small loan at a bank. That counts 30% of your credit score. And then there's mortgage credit, which counts 40% of your credit score. So most of us that are on this video haven't necessarily purchased a house yet. You don't have the mortgage credit history to work with. You have revolving credit and installment loans, which equals 60% of your credit score. And last but not least, 30% of your credit score comes from amounts owed. So once again, that kind of goes back to that new credit thing, amounts owed counting 30% of your credit score. If you have a credit card, you have a $300 limit. If you have it maxed out, then 30% of your score is being affected by having that credit card maxed out. So what you want to do as far as credit cards are concerned, I know they're a necessary evil, but we like people to have credit cards because once again, that's 30% of your credit score that you're getting because of a credit card. So the best way to use a credit card is to never use more than 30% of whatever the limit is. For instance, if you have a $300 credit card, you don't want to use more than $90 on the card ever. And whenever you pay it down, you want to leave 1% on the card. Leaving 1% on a credit card versus paying it off completely can actually get you an extra 3 to 5 points. 3 to 5 points could be the difference between 1% of interest. 1% of interest could save you thousands and thousands of dollars. So what I teach my clients to do is 30 days before you know you're going to go make a big purchase like a car or a house, you pay down your credit card to 1% and you leave it there so that whenever that creditor pulls your credit will be as high as it possibly could be based off of that credit card. There is a few different things about credit that I like people to know. I like people to know about what it takes to buy a house these days. I like people to know about their FICO scoring model. I like people to know about credit and the definitions. So let's talk about the different definitions of things that show up on your credit report. Collections, late payments, charge-offs, inquiries, and public records. So let's break that down a little bit further. We probably know what all of these things are, but there's some stuff about it that you might not know. Like, for instance, on collections. Did you know that paying off an old collection can actually lower your credit score? What? Lower your credit score? Well, let's go over why. On a scale of 1 to 9, 1 being good and 9 being bad, a collection's considered a 9, a paid collection's considered a 9, settled's considered a 9. They're all considered equally negative. Something you do in, say, 2010 affects your credit score less than something you do in 2016. So, for instance, if you have a collection from 2010 and you pay it off, now it's a new paid collection in 2016, a new negative thing on your credit, and actually lowers your credit scores. So what you'll want to do is not necessarily pay in or settle it out. The best thing to do is try to get it removed from your credit if at all possible. So, for instance, when you call them to try to settle out something, see if they'll remove it upon payment, especially if it's an old debt. Or if you're trying to get something like a house or a car, you'll want to try to settle it out right before you close on something like that and just bring the proof that it was paid so it doesn't show up on your credit report and lower your scores right before you're fixing to close on a house. The next thing that I want to talk about is late payments. Late payments actually count 35% of your credit score, which is something that we kind of went over with the FICO scoring model, but people don't seem to understand what that means for your credit score. One late payment can actually drop your score anywhere from 50 to 100 points at a time. So it's really, really important to pay everything on time, especially when you're in our credit repair program. Charge-offs. The definition of charge-off is dead debt. This is something that was with an original creditor. You stop making the payments. It gets about 90 to 120 days old, and then they write the debt off. They collect the taxes and or insurance break on it, and typically they sell it to a collection company for 4 to 6 cents on the dollar. The next thing that shows up on your credit report is public records, i.e. judgments, bankruptcy, tax liens. These are all types of things that we dispute and try to get removed from a credit report. Of course, if they're erroneous. Okay, so let's recap all the things that we just kind of went over. One, what it takes to buy a house these days, FHA, VA, or conventional loans. There's 3 different types of loans out there. And so just kind of make a decision of what kind of loan you think would fit your situation the best. And then make sure to make a plan to be doing those things while we are doing what we do. Remember, as an extra tidbit that you didn't get in the first place, you have to have open trade lines. You have to have something on your credit report that's increasing your credit score, like credit cards or small loans at a bank, in order to get your credit score to go up. Credit repair doesn't make your credit score go up. You have to have the open trade lines. What credit repair does is sometimes take those erroneous things off of your credit report, so that you're taking negative things off your credit report and putting positive things on your credit report, so the only result is that your credit score goes up. The other thing that I'd like to recap on and give you an extra tidbit about FICO scoring models versus Credit Advantage scoring models and everything that we find online. On a FICO scoring model, that's what banks pull. That's considered a hard inquiry. Whenever you have your credit pulled by a credit monitoring company, then that doesn't show up on your credit report as a credit pull. So feel free to get on Credit Karma. Just understand they're going to alert you every single time something changes on your credit report. We have people sign up with the credit monitoring company too. That way we can watch your credit score as you go. Every 45 days we can refresh that credit report so that we can see where you're at with everything. That way we're not causing a hard credit pull on your credit every time we're going to check things out and make sure everything's working the way that it should be on your credit report. And then last but not least, to recap those simple definitions of things that show up on your credit report: collections, late payments, charge-offs, inquiries, public records. These are the things that we address and try to help you the best way we can. So I look forward to working with you. If you have any questions, reach out to your credit coach and we will take care of you. We've been around for 10 plus years now, and we enjoy and love helping people every single day.